I went looking into Ford expecting a story about electric vehicles. That's where the headlines are. A $19.5 billion writes down, a cancelled SUV, a company that seems to be walking back a bet it made a few years ago. I thought that would be the video. Then I found a different number. Up to 90% of Ford's global automotive net income comes from one product line, one family of vehicles, the F-Series pickup truck. Ford sells sedans, SUVs, electric vehicles, commercial vans across dozens of countries. On paper, it looks like a very diversified company, but almost all the profit runs through a truck that has not fundamentally changed its formula in decades. Was that a strength or a warning? I did not have an answer. So I went back further, trying to understand how a company ends up this dependent on one thing in the first place. In 1908, Henry Ford did not invent the automobile. Cars already existed, expensive, hand-built, owned by wealthy families who had previously owned carriages. What Ford figured out was not a machine. It was an inversion of an assumption everyone else in the industry was operating under. The assumption was that cars are a low-volume, high-margin product. Build a few, charge a lot, sell to people who can already afford them. Ford's bet was the opposite. Build a car ordinary people could afford at a price that expands the market size and make the margin back on volume instead of markup price. The Model T launched at $850. 15,000 orders came in within the first 2 days. That alone is a good story, but what built the empire came 5 years later at the Highland Park plant in 1913, the moving assembly line. Before it, building one chassis took 12 hours and 48 minutes. After, it took 93 minutes. Work moved to the worker instead of the worker moving through the factory. Thousands of people each doing one small repeatable task they could learn in days instead of years, rather than hiring expert mechanics. Ford did not keep the savings. As production costs fell, he cut prices, repeated. $850 became $325 by 1921. And every price cut pulled in customers who could not afford a car before, which grew volume, lowering the fixed cost per unit even further and funded the next price cut. It was a loop that fed itself. In 1914, he did something that looked on paper like it should have hurt the company. He doubled factory wages from $2.34 for a 9-hour day to $5 for 8 hours. Turnover before that was 370%. Meaning that for every position, they had close to 4 times annually. The work was efficient but monotonous, and people kept leaving, which is its own kind of hidden cost. There was constant retraining which ate into the efficiency the assembly line was supposed to buy. After the raise, turnover dropped to 16%. Absenteeism fell by more than half. He spent more on wages and made more money doing it, because the instability had been the actual leak the whole time, not the wage itself. By the early 1920s, more than half of the entire American automotive market was a Model T, total dominance. However, the same total commitment to one product and one structure that built the dominance is what nearly ended it. General Motors made a different bet. Instead of one car for everyone, they built a ladder. The Chevrolet, Pontiac, Oldsmobile, Buick, and Cadillac. As a customer's life improved, there was somewhere to move up to. A car stopped being a utility tool once people's basic transportation need was met. It became a status signal. General Motors understood that shift, but Ford, for a very long time, did not. It produced the same black Model T year after year, while the market underneath it changed what it wanted. By 1926, Ford's market share had collapsed to under 30%. In May 1927, they had to shut down production entirely for months, just to retool for a new model. It was not a different company that beat Ford. The same operational discipline that made it dominant eventually worked against it. I went back to that number. Up to 90% of profit from one product line. I don't think it is the truck. I think the truck is just what the structure looks like right now. The same structure shows up everywhere else in the business. Ford reports itself as 4 separate businesses now. Ford Blue, the traditional gas and hybrid lineup with the F-150, Bronco, Explorer, Expedition, and Maverick. It is a cash generator, over $100 billion in revenue. Ford Pro has commercial trucks and fleet services, the most profitable of the four. Ford Model E is the EV and software arm, currently losing billions a year. And Ford Credit, the financing division, which generated $2.6 billion in pre-tax earnings last year. It drives significant profitability by funding dealer inventory and providing retail loans and leases to buyers. Inventory financing allows a dealer to buy products, in this case cars from Ford, without paying upfront. Instead, a bank pays the manufacturer directly. The lender sets up a revolving credit line specifically for this wholesale stock, using the physical cars as collateral for the loan. As soon as the dealer sells a car to a customer, they must immediately pay back the bank for that specific vehicle, plus any accrued interest. So it's a great way to scale a business, but if those cars sit for too long, the interest will eat the dealer alive. By collecting interest on these loans and selling them as securities to investors, it bypasses manufacturing risks like tariff exposure and raw material volatility to provide a stable, anti-cyclical revenue stream. It is the same high-volume strategy Henry Ford pioneered with the assembly line in 1913, except today, the factory output is not just physical cars, it also has auto loans. The strain Ford is facing does not come from sales. They sold close to 2 million vehicles in the US last year, the most in the industry. It is showing up underneath that number. In a balanced market, car inventory sits for an average of 60 days. Ford's average is 96 days. The Lincoln Aviator alone sits at 420 days. Warranty and recall costs rose from 1.6% of revenue to 2.9% last year. They had a $19.5 billion write-down to unwind EV plants that did not reach profitable volume. A write-down reduces the recorded value of a company's assets to reflect their actual loss. For example, let's start with an initial book value of their EV factory at $500. 2 years later, consumer demand shifts drastically away from EVs, and Ford realizes it cannot sell enough cars to justify the factory's massive operating costs. Independent auditors evaluate the machinery and property, and due to the low demand, the fair market value of the facility today drops to $200. So to bridge the gap between what the factory is listed for on paper and what it is actually worth today, the company subtracts the current market value from the initial book value. That becomes the write-down amount. In the balance sheet, the factory's value is permanently lowered to $200, and in the income statement, a $300 non-cash expense is logged, drastically cutting reported profits for that quarter. Those figures are just my own to explain, by the way. So none of that shows up as a sales problem. The sales look fine. It shows up as everything downstream of the assumption that one structure, one product, financing engine, and operational bet will keep working the way it always had. I don't think Ford is a truck company having a bad quarter. I think Ford is a company that has built one very good machine a century ago for turning volume into margin, and it has spent every era since figuring out what to plug into that machine. Cars, then trucks, then financing, and right now the plug is the F-150. The machine does not seem to care what is plugged into it as long as something is. A consultant who has one client producing most of their revenue is running the same structure, just smaller. The invoice looks fantastic and the month looks healthy. However, the architecture underneath it has not actually been tested yet, as that client relationship still works. It is the same shape as the F-150. It works right up until the moment something you do not control decides whether it keeps working. Here's where I've landed, at least for now. Concentration itself is not a mistake. Ford's entire history says total commitment to one thing done extremely well is how you get to a Model T or a F-150 in the first place. The mistake is not knowing you are dependent on a single structure until the E8 gets tested. See you guys in the next video.